Have you ever looked at a massive office building and just wondered, what is that thing really worth? It feels like an impossible question, right? But the answer is actually found in this surprisingly structured document, the Commercial Appraisal Report. And it's not just some dry collection of facts and figures, it's really the story of a property's value. So let's turn the first page together. And hey, whether it's a skyscraper, a local shopping mall, or a giant warehouse, this document is what banks, investors, and even courts rely on to make huge, multi-million-dollar decisions. Understanding how this story is written, well, it's absolutely crucial, because it's the foundation for some of the biggest financial deals in the world. So here's our game plan for this explainer. We're going to take a guided tour of a typical commercial appraisal. We'll start with the big idea of the report as a story. Then we'll look at how to get the key info super fast, see how appraisers set the scene, explore the three main ways they figure out value, watch how they land on that final number, and wrap it all up with the all-important fine print. Okay, first things first, let's reframe how we even think about this document. It's so easy to get lost in the numbers, but really, the best way to understand an appraisal is to see it as a carefully constructed argument, a narrative that builds and builds towards a single defensible conclusion. The key words to grab onto here are narrative and defending. An appraiser isn't just slapping a price tag on a building, no way. They are building a case, piece by piece, to explain why a property is worth a specific amount, and then defending that conclusion from all sides. Think of it like you're reading a book. Most of these reports follow this same four-part structure. You've got the front matter, that's your introduction and summary. The core description sets the scene. The valuation analysis, well, that's the exciting part, the rising action, where the big question, what's this thing worth, is tackled head-on. And finally, the conclusion and backup provide the climax and all the footnotes. Now look, these reports can be monsters. We're talking over 100 pages long. But here's the thing, they're designed for busy people too. So let's look at just the first few pages. This is basically your cheat sheet for getting the essentials in just a couple of minutes. These first few pages are the ultimate cheat sheet. You'll find the title page, which is, like the cover of the book. Then there's the letter of transmittal. Think of this as the formal handshake from the appraiser, where they officially deliver the report and state the final value right up front. And the best part? The executive summary. That's your spoiler alert, giving you a snapshot of the entire story in just a page or two. And this is so crucial. The appraiser lays out the rules of the game right from the get-go. Is this report for getting a bank loan? Is it for a legal dispute? This context is everything. It defines the lens through which all the data is analyzed and tells you exactly how much you can rely on the conclusions for your specific needs. Okay, next up we get to the descriptive core of the report. Before you can put a price on something, you have to understand exactly what it is and, where it lives. This section really details the property's unique identity, its DNA. You get all the physical stats, its size, its age, its condition. You get its resume, its sales history, and who owns it. And you get its rule book, the local zoning laws that dictate exactly what you can and can't do on that piece of land. And this just brilliantly illustrates that a building doesn't exist in a vacuum. The report zooms out to analyze the whole neighborhood, the city, and even the regional economy. Is the area growing, or is it shrinking? What are the local vacancy rates? Because a fantastic building in a failing market, well, that's not a fantastic investment. Now, what's really interesting here is the concept it introduces. Before running any numbers, the appraiser asks this fundamental question. What is the most profitable thing you could possibly do with this property? Is it keeping the building as is, tearing it down for something new? This decision becomes the absolute foundation for the entire valuation that follows. All right, we've set the scene. Now we get to the main event. This is where all that descriptive data gets transformed into hard numbers. For most commercial properties, it really boils down to two main roads to value. The income approach asks, how much money can this property generate? It's a lot like valuing a business based on its profits. The sales comparison approach asks, what if similar properties sold for recently? It's kind of like pricing your house by looking at what your neighbors just sold for. So, the appraiser digs deep into the rent rolls for the income approach. For the sales approach, they find comparable properties and make these detailed adjustments for any little differences. And then there's a third path, the cost approach. This one asks, what would it cost to buy the land and just build this exact building from scratch today, minus any wear and tear?
This cost approach isn't used all that often. But think about it. You can't really use the other methods for a brand new building that's never had a tenant, or for a really unique property like a school or a church. So in those cases, the cost to rebuild becomes the most logical way to figure out its value. So we have up to 3 different paths, each probably leading to a different number. How does the appraiser get from 3 different estimates to one final answer? Well, that's the art of this final step.
So the most crucial point is this is not a simple math problem. The appraiser doesn't just add the 3 values and divide by 3. This final step is an act of professional judgment, and it's called reconciliation. They analyze the quality of the data for each approach and then decide which path tells the most reliable story for this specific property. Here's a perfect example of that judgment call in action. For a fully leased office building with a long history of income, what matters most to an investor? The cash flow, right? So the income approach gets the most weight. The cost to build a new one is almost irrelevant, and the appraiser has to explain this reasoning crystal clear. And after all that research, all that analysis, and all that judgment, we finally arrive right here. A single, defensible number. This is the climax of the story, the culmination of the entire report.
But the story isn't quite over. The final section provides the foundation of credibility for everything that came before it.
The addenda are basically the proof. It's the show your work section of the exam. Here you'll find everything from maps and photos to the actual financial statements and comparable sales data they used in the analysis. This transparency lets another expert follow the appraiser's logic and test their conclusions.
And finally, we have the appraiser's professional oath. These are statements confirming they're independent, that they're following strict ethical and professional standards, and they lay out any specific conditions that might limit the report. This is the bedrock of trust. So, you see, a commercial appraisal report is far more than just a number. It's a snapshot in time, a detailed narrative of a property's past, its present context, and its potential future. But markets shift, tenants change, and cities evolve. The value today is really just one chapter in a much, much longer story.